Hi guys, and welcome to yet another episode. So in this episode, I'm teaching you all about market structure and how to get the best trade, the best entries and the best exit out of the market. So buckle up and enjoy. So market structure. So what is market structure? Market structure is if a market is market structure is the movement in a market either in an up direction or a down direction or the sideways. So there are three ways in which a market can move. A market can either move in an uptrend, a downtrend, or sideways. So today I'm going to teach you all about uptrends, downtrends, and sideways markets. So in this episode, I'm teaching you tricks on how to get the best entries, how to use support and resistance and trend lines in conjunction with market structure. So uptrend. An uptrend is simply a market that is moving in a series of up. So this is an uptrend. Simply, the market is forming a low, then a high, then a higher low, then a higher high, a higher low, a high, and so on. So this is an uptrend. As you can see, the market is moving in this direction. So simply put, this is an uptrend. A downtrend is just an inverse of the same, with the market moving a series of down movements. So this is the first high, this is the lower high. No. So this is a downtrend. So the market was here first, high. This high is lower than this high. So this is a lower high, lower low, lower high, lower low, and so on. So this is a downtrend. And for the sideways market is simply a market that is moving in sideways. So simply put, the market is moving in from, this is the first high, this is the first low, high, low, high, low, high. So this market is in a downtrend. This is in a sideways market, as you can see. So the trendline tool is used to identify this, makes it a little bit easier. So to use this, so I'm going to teach you how to identify the uptrend, downtrend, and sideways. So in my other videos, I taught you all about support and resistance and trend lines. So these are the two tools that help you identify this easier. So for an example, so let's say this is our support and resistance zones. For a market that is moving in an uptrend, price finds support on the zone and resistance on the zone. So if the market is moving up, this becomes resistance, support, resistance, support. So this is using together with support and resistance. As you can see, this is support and resistance. But to make this a bit more easier for you, you can just find two of the previous lows and draw a trend line. So let's say this was the first low, the second low. Find this market structure using trend lines and support. So this was the first low, the second low, and the third low. So you can take a trend line, identify the first two lows, and draw a trend line from the first low to the second low. So remember, there are tricks that you have to use in order to identify these trends to identify accurate trends. First and foremost, for a trend line to be valid, first it has to touch the lows, the first two lows. You must not cross through you must not cross through a candle. It must touch the wicks of the first two lows. So you can do it from the candle, but the wick is the best according to how I trade it. So you take the first two wicks at the extreme lows and identify the trend. It must not cross through. It must not be forced. So what do I mean by forced? You can have a trend line touching the first low, but the second low does this, and the third low does this, and the fourth low breaks through, then continues. So if you can check this low and this low, but this trend line is forced. What do I mean by forced? Yes, you can trade the trend line, you can make money using the trend line, but it is not an accurate description of how the market is moving. You can't use it to make the best trades. So for the best trend lines, it has to touch the wicks of the first low. So let's say this is the first low, then the second low. This is the extreme point, and this is also the extreme point. Check the trend line through here and here. So if the market does this, doesn't touch, does this is still the accurate description of the trend that the market is moving in. So for this downtrend, just an inverse of the same. So for the sideways, this is where it's a bit different. For a sideways movement, you don't use the trend line. Don't use the trend line for sideways markets. This is simply because if a market is moving sideways, let's say this market is moving in this direction, and it's touching through here and here, trend lines can be very subjective in sideways markets. What do I mean by subjective? You can check this trend line here, the first low and the second low, and draw a trend line. But the market can still do this. This does not validate the sideways market, but it invalidates the trend line. So for better, you have to use on sideways markets, you don't use the trend lines. You use support and resistance. This is because support and resistance is a zone, not a line. So the market can simply come touch the zone, the next zone, come touch this zone, the next zone up here, touch here. So as you can see, the market touched here the first time, here the second time, here the third time, here the fourth time. There is no consistency in the lows, so I can't use a trend line to identify these lows, but I can use a zone, because a zone is simply support and resistance is a zone. So simply the market can touch on the zone, can touch inside the zone, or can cross the zone, but still remains valid. So that is how you use trend lines to identify support and resistance. So I'm going to teach you how to use this to take trades, not just using them to identify. So for an example of an uptrend, so if this market is moving in a series of highs and higher lows, so to identify the best setups, this is a zone here. So technically, if you buy here, you'll still be in a winning trade. If you buy here, you'll still be in a winning trade. But this is not sustainable. By sustainable, I mean you have to find a way that anytime you use the same method, you will always be guaranteed to make profits. Not guaranteed, but you'll have a higher probability of making profits than making losses. So combining market structure together with support and resistance and trend lines is vital to ensuring that you get the best trades, the best entries, and the best exits. So for an example, I want to use a very simple example so that it is easier to understand. So if this market is moving in a series of up, low, so if this market is moving higher, you can always wait for the next high to buy into the uptrend. So that is simply as it comes, but it is not as simple as that, because how do you know this is the low? How do you know that the market is bottoming? The market can simply come, do this, then continue down. How do you know that the market this is the low to buy, this is the low to wait, and this is a low not to take the trade? You can do it very simply by using support and resistance. So if this is support and this is resistance up here, by identifying which support is vital to the overall trend, that is the only way you can use this knowledge that you have to make profits. Having knowledge and using knowledge is not the same thing. You can have knowledge and still lose money consistently. So I'm going to teach you a few tricks on how I use so that I can identify the market and the best possible entries for these trades. So in this case, I'm going to use market structure, and I'm going to introduce another concept called price action. So if the market is simply moving in a series of uptrend, by identifying the trend and the support and resistance zone, support and resistance are areas of interest. By areas of interest, I simply mean that this is where all the buyers and sellers are looking for taking opportunities. If the market is moving higher and it is in an uptrend, the sellers are still expecting to short the market. So you have to know one very simple thing. Not just because the market is moving higher means that the market will continue moving higher infinitely. The market can still change direction midway anytime. So the best way to ensure that the market does not reverse on you is to know the best areas to look for taking your trades. So by taking your trades at a support zone, you eliminate the risk of the market going lower because there are buyers still waiting to buy here. The sellers might be strong than the buyers. So to know if the sellers are stronger than the buyers, we use price action. So I'll teach you more about price action on my next video, but I'm going to teach you a few tricks on price action that you can use to identify market structure and take the trade. So if a market has been moving a series of downward spirals, so let's say the market was moving up. So this is a downtrend. But the downtrend is coming from a strong uptrend. To identify the best place to take this trade and continue the overall uptrend from this downtrend, as you can see, the market is in a downtrend, but we are looking to continue buying. So you first find the main support and resistance zones in this market. So let's say this is your resistance and this is your support. You just don't buy at any support and resistance because the market can still reverse on you. So if this market has been moving up, then forms this consolidation to the downside, initially a downtrend. So we have to wait for this market to reach this zone. So if this market reaches this zone, we are anticipating that the uptrend will continue, but the market is still in a downtrend. So we have to wait for the buyers to actually confirm that the market is now moving in an uptrend. How do you do this? Simple. You wait for the market to reach your zone of this is a zone of interest. This is support. This is resistance. After the market comes here, so this is a downtrend because the market is breaking the lows. The market is breaking lows consistently and moving in a downtrend. So we have to wait for a reversal. A reversal simply means that if a market is moving in a series of downtrends and we are now anticipating for buying, we have to wait for the market to actually show us that the buyers are present. How do they show us that they're present? First, we have to wait for a sort of reversal pattern. A reversal pattern simply means that shows that the buyers or sellers are getting weak from a certain point. If, let's say, they come here, this is our zone of interest, we have to wait for the reaction from the zone. If the market comes and retests here, Simply put, the market is continuing in a downtrend. So not buying here saves us this loss of taking the trade and reversing. So we wait. If the market comes, touches here, drops, then buys impulsively, this might become our first signs of buyers changing. So the buyers might be coming into this market, but you just don't buy because this low is higher, because the market can simply just come and continue lower. So what do? Use support and resistance. So since this zone was what we're interested in, wait for up. The buyers come and take this entry impulsively to the upside. So this was the first break of structure to the opposite direction. So this shows that the trend line from the downside is now becoming bullish. So I hope you understand this concept. So in the next video, I'm going to show you how to use this same concept together with price action and ensure that you get the best entries for your trades. I'll also include some practical example on the charts for you to understand this concept better. So bear with me and stick with me to the next episode. So remember to like and subscribe this content for more, and peace.